Hello, this is Seewing. Welcome once again to our weekly video update on various aspects of the real estate housing markets. Welcome. If you receive value from this short video, please click the like button and subscribe to my channel. And furthermore, if you wish to become a free member of our real estate community, our real estate investment club, if you will, just go ahead and at the bottom of this video, on my website, just submit your email into our newsletter so you will receive your weekly great information update on various aspects of real estate education and real estate investment opportunities in the best markets in the country, cash flow markets for turnkey investors. So without further ado, let me share my screen. Today we're going to talk about the Redfin update. And today's article is Housing Market Update, Rising Prices Amid Falling Demand and Supply Reflect a, quote, new weird, unquote. Wow. I tell you, the housing market, various organizations is steadily coming up with some new buzzwords, for better or for worse. So let's dive deep on this article published on September 22nd by Redfin by the author Tim Ellis. And the title, once again, few people are choosing to buy homes with mortgage rates well above 6%. Yes. Even fewer homeowners want to sell. So this downward trend will be very interesting. And we are going back to the supply inventory of being very low again. You know what happened in the past several years during the pandemic when the supply of inventory is very low, and wait until the demand creep up higher down the road. But however, if the interest rate is hovering around 6%, for right now, at least temporarily, a lot of people are being priced out of the market. But here's my take on this. I believe there's a lot of people are sitting on the sidelines. The rest of this year, for the next 3 months, is a seasonality kind of situation. There's every year, the fourth quarter of each year, the last 3 months, we always have less real estate transactions. So just keep that in mind. The beginning of 2023 will be very, very interesting. Very, very interesting, something that we have never experienced in recent memory. Okay, let's go on with this short article and some of the highlighting aspects of it. I'd like to cover this. And the Redfin Deputy Chief Economist Taylor Marr says there has been a lot of talk about new normal, quote unquote. But what's happening in the housing market feels more like a new weird. How do you define a new weird? Well, let's dive deeper into this article. The vast majority of homeowners who might consider moving have a mortgage rate far below the current levels. So the sellers, they are sitting tight on their 30-year fixed rate mortgage at a historical low rate. They have very little incentive or motivation to sell their home, to move up to a new home, paying 6% or higher on a higher priced home. Potentially, they could have to double their monthly mortgage payments. That's not a good sign. So unless somebody really, really have to sell, they will sell. Otherwise, sit tight on your amazingly historical low interest rate of 4% or less on 40% of all the mortgage holders in this country, which is mind-boggling equity growth achieved by those people who own investment homes and for those people who own primary homes and second homes in the various parts of the country. So I congratulate to you who pull the trigger. If you invest for the long term, you're going to even benefit from this tremendous wealth cycle increase. So, okay, leading indicators of home buying activity. Let's go on with this article. For the week ending September 22nd, 30-year rate mortgage rose to 6.29%, which is the highest level since October 2008. And there are fewer people searching for home for sales on Google, down 33% from a year earlier, from 2021. And then also the home buyer demand index, which is a measure of requests for home tours by Redfin agents, was also down 15% year over year. And mortgage purchase applications were up 1% over a week, seasonally adjusted, but we're down overall 30% from a year earlier. That's pretty obvious, right? There's less people have the motivation to buy a home. Therefore, because of the affordability factor and higher interest rate, higher monthly payment, so there's a lot of pullback from people getting home mortgages. So, all right, let me see what else we can talk about for the remaining few minutes. Key housing market takeaways for 400 plus U.S. metros. It is called MSA. You know, that's an acronym meaning metropolitan statistical areas, I think. MSA. Yeah, that's what it is. 400 metros in the U.S. There are so many cities and regions and metros. By the way, there's no such thing as a national real estate. Real estate is local. Every local market acts differently from another market in terms of economic drivers, in terms of geography, in terms of level of activities, and in terms of pricing reductions, pricing increases. So for those of you out there, your primary homeowners out there, target where you want to live long term and buy into the market you want to buy. For risk investors, you have a much more wide selections, much more flexibility to pull the trigger in a specific local neighborhood or local market. That's the goal. If you can find a sub-market which you can buy an investment property where the home prices are low, affordable markets, and then the rent is very, very high to cover the debt service and do a 25% down payment, even at a 7% interest rate, you may still cash flow. That is what's happening with investors these days, right? Investors, you buy for yield, for rate of return, for good 1% or a little less rent to value ratio, capitalization rate of 5%, all those numerical formulas that investors need to crunch the numbers in order to buy at the right market. At the right market, most of the time are in the South and Southeast, and then Midwest, there's a potential for very low price purchase points with very good cash flow, just so you know. Needless to say, I live in San Francisco Bay Area for more than 3 decades, and we see our market is very cyclical. That means it's up and down right now. Clearly, from a nationwide perspective, more homes fail in value than in California than anywhere else. Specifically in the Bay Area, San Francisco fell 6% year over year. Across the Bay in Oakland, prices fell a mere 2.5%. The others are very, very minor. New Orleans, 10%, not minor. But anyway, the top five metros of price, slight decline. We don't know. Moving forward, the median asking price of new list of homes are increased 9% year over year. So we still see a appreciation of 9% nationwide median asking price. So again, the big picture is the high level is we're still seeing increasing housing prices from year to year. So far, right? So far, September 22, 2022. So the median price is 381 to 50, depending on a specific market. But you're going from 3% into a mortgage rate to 6%, obviously, right? The payment will increase another 45%. That's why so many people are pulling back from buying because of They can't afford anymore, and that's how it goes. Pending home sales were down 21% year over year, the largest decline since May 2020. If pending home sales are low, this means the inventory supply is very low as well. And so we see some opportunities down the road if there are so little homes to sell, especially when the demand is creeping up, depending on the interest rate situation moving forward. Does that make sense? New listings of homes are down 20% year over year. So everything's down. Home sales are down. Yeah, technically it's a house recession, but at the end of the day, there on the other end of the spectrum, there are some opportunities for home buyers and especially for real estate investors that can profit from people who cannot afford to buy, they have to rent. So we have seen some historical growth in rental increases. In history, we're seeing more renters than ever in history because I've been doing this for 30 years. That's how it is. So whenever there's a crisis, somebody has to win in a market condition. And I believe a real estate investor have the ability to win if they know what they're doing, if they go into a specific sub-market away from this high-cost area, go to low-cost areas, fast-growing areas of the country with very, very low cost of a purchase and much higher rent to cover the cost of the debt service. That's what an investor looks for. All right, so months of supply, again, 4 to 6 months is a balanced market. Right now, even though the inventory slightly increased to 2.8 months, typically still a seller's market, still inventory is very low and demand is still high. So this means it's a very much seller's market. We're not going to see a buyer's market. It requires 5 to 6 months of inventory to achieve a healthy buyer's market, and we are nowhere near that level, and not for the foreseeable future. It'll be a long time to come because nationwide, on a high level, we still need almost 2 million homes per year for the next 10 years. We're still short anywhere from 3.8 million homes shortage, 3.8 to 4 million, depending on who you talk to. So we have a massive, massive amount of home shortages that started way back more than 10 years ago at the height of the last Great Recession of 2008. All right, so even though you're seeing all kind of information about buyers getting the upper hand, become a buyer's market, I don't think so, because nationwide we are still short of almost 3 million homes. That is astronomical. You need to increase level of inventory by 300% right now in order to achieve a balanced market nationwide. We're nowhere near that level, especially with the decreasing home sales, decreasing everything I've been telling you about on this article. It's just mind-boggling. So I'm almost finished with this. This graph is just merely just validating what I just said. The prices are still increasing, although we're seeing some trends in some high-cost areas. You do see some price reductions, around 5 to 10%, mainly in California, Northern California, Southern California, and few other areas like Boise, Idaho, some slight declines in Las Vegas and Boise, Idaho, and Austin, Texas. But this price decline is just a correction, a slight correction. We do not see a crash because many homeowners have massive amount of wealth and equity sitting in their house, and they are not under stress by any means whatsoever. So this is not 2008. It's not a crashing situation. I don't care what YouTube video or saying the C word, the crash word. Anyway, no need to go through the graph because I already covered everything. So my takeaway is, once again, to some of you, this kind of market condition is very confusing. You don't know, nobody's really understand what's going on. But at the end of the day, my take is we're seeing lower and lower inventory. So sellers are not selling. buyers not buying because the rate is so high. So something has to give. If the interest rate goes beyond 6% to 7%, then I don't know what's going to happen. A lot of people is going to panic one way or the other. However, if the interest rate is going to decrease from 6% to 4.5% to 5% in the next 12 to 24 months, then we will see a lot more housing activities, giving the extreme low amount of inventory. So remain to be seen. I have my own opinions and ideas. I'm very optimistic in terms of the housing market rebounding to a certain level. It all depends on the interest rate and the people in the sideline. I believe that a lot of people in the sidelines waiting to pounce on this market. Real estate investors, especially, they know how to crunch the numbers. They will pick a sub-market to purchase ahead of everybody. They're doing it right now. In fact, that's what I'm doing. I'm helping our investors to buy in a very specific sub-market, which is not really talked about, right, by the national news media. So that's all I have to say. Yep. So again, if you see a lot of value from this video, please click the like button and also subscribe to my channel. And finally, just input your email into my website at the bottom of this video, so you can receive free weekly newsletters, so you can see great investment opportunities for you as a real estate investor to buy great cash flow homes in the greatest, fastest growing market, especially in the South and Southeast. All right, thank you so much for listening. This is Seewing, and I will see you on the next video. Have a nice day. Bye-bye.